Rehab, are we good? Excellent. All right. Ladies and gentlemen, karibuni. Thank you for your patience. We have most of the members of the Fourth Estate present: Karibuni, KTN, Citizen, NTV, Bloomberg, Trading Bells, Maina, Karibuni, Bella, Karibu, Kefa, Karibu, Liz from Business Daily, Karibu, Esperanza from Radio Africa, Karibu, Red House PR team, Karibuni, Ogilvy Agency, Karibuni, NCBA marketing team, Karibuni. We now have our group managing director, Mr. John Gashora is here, and shortly we will start our program. We also have our online bloggers. Steve Biko is here, among many others. Karibuni, thank you very much for joining us. Great, Karibu, Mr. Gashora. Ladies and gentlemen, we are ready to start. Okay, good morning to everybody. Good morning. I mean, we've all had breakfast, so I'm hoping we can be a bit more lively this morning. Good morning. Thank you very much. I know it's a rainy morning, but we appreciate rain. We've had quite a situation with our country, but this is a global situation. So thank you for the rain. Thank you very much to the members of the Fourth Estate who are here. And for those who are not here, we'll be able to avail the recordings of the day. Welcome to the third quarter 2022 financial results for NCBA. On behalf of the Board of Directors, the Executive Committee that's represented here, the staff of NCBA, thank you for making the time today and joining us for this event. Today's program will be very brief and straight to the point. This is our quarter 3 results presentation. So we'll kick off with some remarks from our Group Managing Director, Mr. John Gashora. We will then follow up with our Group Director for Finance, Mr. David Agboga. We'll get into the financial results in more detail. And after that, we will have a Q&A with a panel of 4 people. I understand there's some questions from the Fourth Estate. So we'll manage that through our PR agency. So we'll have our Group Managing Director, Mr. Gashora, David Agboga, joined by Louisa Wandabwa, our Director of Strategy and Chief of Staff. And also we will have our Group Director, Business, Digital Business, joining us on the panel for any questions that you might have that are not covered on the press release or during the presentation today. After that, we intend to have a Q&A. Please, during the Q&A, which will limit to about 10 minutes, introduce yourself, the media house you come from, and we'll take 4 questions at a time so we can manage our time this morning. We should be done by 10 a.m. as we have another engagement. After that, we have some interviews right outside with our Group Managing Director for the media houses that wanted some special commentary from today. And then we will have a special interview with Trading Bells at 10 a.m. That will be the end for today. The social media hashtag for today is hashtag NCBA Quarter 3 Results 2022. That's already trending. And it is now my pleasure, ladies and gentlemen, to invite our Group Managing Director, Mr. John Gashora, to share his remarks. Asanteni.
Okay, thanks Nelly. Good morning, everyone. and welcome to this morning briefing. I presume I've seen a number of you already write about our results, so you have already seen the results. So let's make this more interactive. So what we'll do, I'll be very quick, and I'll go through some high-level stuff about the organization, and then we shall have a presentation by our digital team led by Eric Muriuki, and then we shall go through the financials, and after that, as Nelly has said, we'll be available to answer any questions that you might have. I think you all know our bank, but it's worth, I don't make the assumption that everybody who is here today was there the last time we had this conversation. So just very quickly about our bank. We were formed 3 years ago as NCBA by the merger of CBA and what was then NIC. NCBA, is one whose purpose is to be the financial services partner that inspires your growth. And I'm assuming, first of all, that all of you are customers of NCBA. So in my speaking to you, I'm speaking to you as customers of NCBA, not as just media houses. Yeah. If you're not a customer, you need to identify yourself. So we can make you one right now before we go too far. Just raise up your hand if you're not a customer of NCBA. We need to convert you first. Anyway, our values, driven, open, responsive, and trusted. And that is exactly what you get when you deal with NCBA. What makes us different is that we care a great deal. We are passionate about customer experience. We are passionate about delivering excellence to our customers. And as I always say, banks have the same products, more or less. It's how we deliver those products that makes us different, that we're able to give you attention as a customer. We're able to have your own relationship manager. And also, we are able to work with you through innovation and look at your particular needs, not assuming that you have the same needs as every other customer that we have. We are in quite a few countries. We are in 5 countries, Kenya, Uganda, Tanzania, Rwanda, and Ivory Coast. We are one of the few banks in Kenya that have presence in West Africa. We serve over 60 million customers across Africa. And I've said before, we're the largest bank by customer numbers with 60 million customers and with over 100 branches spread across our presence markets. We've talked about our ratings. Once again, we are rated by Fitch, Global Ratings, B+, the same rating as the country. And I've said before, strong business profile, a good profitability, as you shall see. But of course, with the same areas of concern, as I've seen some of you write about the industry, loan quality, deposit structure, and of course, the operating environment, which I shall go over very, very quickly. We've been recognized for a number of accolades. Which is supposed to come down with some accolades. Best Financial Services Group in East Africa by Global Finance. That best in customer experience, an area that we are proud about, as I said, and an area of work. Best Global Bank 2022, again by Global Finance. Fifth best employer by LinkedIn. So we also care very much about the people who work for us. And the most preferred asset finance bank in Kenya. In Uganda, we got the Corporate Governance Award. Again, something we care about greatly, about how we manage our governance. I talked about the operating environment. So let me cover a bit about the operating environment. I think it's clear that we are going through a tough time as a country. I see Louisa is menacing because it's not coming up the way it's supposed to come up. Huh? Sorry? Behind me it is. Yeah, sorry about that. Then I guess I have to remember what it says. Huh? So I think we all know we're going through what you call, it's almost becoming a global cost of living crisis. It's not unique to Kenya. The global growth, no, I'm good. I've got it. Cost cost of living crisis. And this is primarily driven by the fact that coming out of COVID, the war in Ukraine and Russia, obviously the disruption of supply chains and even manufacturing chains have meant that cost of goods across the world have gone up significantly. Coupled with the fact that during COVID crisis, there was a lot of stimulus that was given to the economy. As you know, in developed markets, were writing checks to their citizens. And that meant a lot of money supply, little supply of goods, and therefore, obviously, the demand has driven prices significantly up. And because of that, global growth is projected to moderate from 2021 to 2022, as you'll see there. Again, I hope you can see at least the graph, 2022 moderation. And if you look at the projection for 2023, is even lower than 2022. The other side of that you see is the monetary policy actions that are being taken across the world. Again, the three graphs, maybe I can talk about the red one because it stands out. On the red one, what you see there is the actions taken by the Bank of England, what the Bank of England base rate has been set at. And what you see, we went through a really long period of stability, very historically low interest rates between 2008, and that was driven by the need to stimulate the economy coming out of the global economic crisis, and all the way to beginning of really mid to late 2021, when the central banks have started responding to a very high inflationary rate. And what you see again, the graph to the left bottom, is talking about headline inflation. And what you see is that all across the world, inflation rates have really grown at a staggering rate. They got as high in the US, I believe, 9.6, which the last time they saw a rate like that was in 1980s when Ronald Reagan was president. That's how far back you have to look. The UK at 9.2, around there. Again, the highest it has been since Margaret Thatcher. And indeed, some reports were projecting that the UK will have an inflation rate going to 16% next year. But given the actions that I guess the Bank of England has taken, hopefully we don't get there. We are not unique. We're not unique. If we turn to Kenya, what you see is our annual inflation clocked 9.6 in October. Again, one of the highest it has been for a long time. And that has obviously forced the MPC to react, the Monetary Policy Committee. Hence, if you look at the actions of the Monetary Policy Committee, as late as yesterday, they raised the central bank rate by another 50 basis points. So we are currently at 8.75% in terms of the CBR. That is supposed to control inflation. But of course, we are doing it in a period when we have a cost of living crisis as well. So it's a very difficult period because what you don't want to do is control money supply when there is a cost of living crisis. Yet, at the same time, you must control inflation. Otherwise, the cost of living crisis will continue for a long time into the future. The NSE 20 index has responded as well. It's down close to 15% year over year. A lot of it we have seen a lot of foreign investors flee, but it's not just Kenya. Foreign investors are going through what you call capital reversion, where they are taking money from emerging markets, from frontier markets to developed markets because the rates in those markets has gone up significantly, that they're able to earn attractive returns by investing dollars into the US treasuries, for example, or indeed the UK treasuries as well. We have also responded. Our interest rates have been going up. Again, the graph at the bottom doesn't look very good. The graph at the bottom, the rates have responded and rising significantly. So let me talk a little bit about the banking sector. The banking sector seems to be backing this trend that I just described, the gloomy trend that I talked about, continuing to grow quite significantly. Total deposits are now at 4.6 trillion shillings. Gross loans in the banking sector, 3.6 trillion, and really just continuing to grow. It means that the banking sector is responding to the needs of the economy, that we continue to provide the support the economy needs. And indeed, we have seen private credit has grown since the lows that we saw during COVID. The strength of the banking sector remains to be high. Capital adequacy ratio for the industry is at 19%. And I guess the other metrics you look at is NPL ratio, which has been fairly stable from 2020 at about 13.6 during COVID, sort of remained that. I believe now it's about 13.7. So pretty much stable during that period. So let me now turn to NCBA specifically. If you look at NCBA, should we just change this? No? Okay. That's better. Sorry about all this. It's technology. And you know what I've called it before. I won't say that again. To our specific strategies, 5 priorities. Again, this is something most of you have heard about our 5 priorities. I guess from a business growth, scaling retail banking, expanding our distribution. We've been opening branches, and I'll talk about that in a second. Deepening our leadership in corporate banking. Again, I'll talk about this. Digital transformation, we'll cover it very quickly. All that to give a distinguished service and service excellence to our customers. And of course, all that will be driven by making sure we invest in our people to have a high performance employee culture. We've talked about the execution roadmap. We are in segment D, which is implementing these strategies. So we've done everything that's A, B, and C very well. And now we are part D, which is that execution of those priorities. Every year, we take those 5 priorities, and on them, then we choose the particular priorities of focus. And this year, based on the fact that now we're in that phase D, our 4 priorities were: 1, customer experience, delivering on customer experience. Remember, we're coming from a period of getting our system together. I've seen comments on Twitter that our systems now are very stable, but we came from a period of getting our systems together, and we need to ensure that our culture, our people, our systems are ready to deliver brand love. Second thing was business growth. Again, coming out of 2020, the merger, 2021, the merger, we needed to refocus externally to start building our business. Controls, I've talked about this before, that when you merge, when you're changing policies, when you're changing frameworks, controls do tend to suffer because you're trying to do things very differently from what you're used to. You're basically teaching old dogs new tricks. And you know that old saying, it's a process. And what suffers is then controls. So a lot of focus to make sure that we have robust controls, being the kind of bank that cares a whole lot about the safety of deposits that our customers entrust us with. And of course, regional business. Last year, when we reported our results, a lot of you focused on the performance in our regions. And if you recall, we reported a total loss of 1.5 billion Kenya shillings contribution from our regional businesses. So this became a real focus at board level, a real focus for us to turn that around. And hopefully you see from the results that that has indeed turned around. So if I go through just each of them very quickly, on brand known for customer experience, we look at it through a number of measures. One of them is Net Promoter Score, Customer Effort Score, and of course, service level agreements, how we're delivering on this. And we measure them quarter by quarter. So what you see here is that there has been growth in each of these measures quarter after quarter. A Net Promoter Score, very important, because it speaks to how customers experience us, giving us direct feedback. And as you can see, we had 55% Net Promoter Score. I've been asked, what is a good Net Promoter Score? I must say 55 is a damn good Net Promoter Score. The best organizations are about 60s, and the very, very excellent, this is a global score, at about 70. So at 55, we're doing quite well. We're not there yet. we shall do more. Of course, brand comes with not just what you do for your customers, not just what you do for your staff, not just what you do for your shareholders. It matters a great deal what you do for those who give you the license to operate. That's a community. Community, the citizens give you the license to operate. And we're very clear that our social impact must be tracked and measured. On that score, I think you'd have seen us. We, in 2021, launched the NCBA Golf Series when everybody was huddled at home. Nobody wanted to go into contact sports. We came up with the NCBA Golf Series. And we went further. We said it's not just about getting the golfers to enjoy their golf. We're going to invest heavily in the future generations. So we launched the NCBA Golf Series for juniors, which was a big hit. And you'd have seen this year quite a number of corporates have come forward. And we asked them to come forward to join us in this effort to train juniors. And that has been a great, great success. Those of you who have kids, please make sure you enroll them for golf, at least in the next golf competition or golf training or golf clinics that we do for kids. Education, we don't brag about, but we work through foundations to support hundreds and hundreds of kids in school. And this is something we do through foundations. And lastly, you've all heard me talk about change the story, something I'm very passionate about. Everybody is talking about COP27, about net zero. At NCBA, we believe that all of us in individual measures can do something to help towards that net zero. And we believe the easiest place to start, at least for Kenya, is in planting trees. So our Change the Story campaign is all about rallying everybody to plant a tree, to plant trees during the rainy season, because we believe that way, every single individual, every single Kenyan will contribute. I always ask myself, if we planted a tree for every Kenyan, those who cannot plant will plant for them. If you have 5 kids, you plant 5 trees plus 2 for you and your spouse. Those are 7 trees. If we all did that, every year Kenya would plant 52 million trees. That will make a difference. That will make a difference. And there are trees for every region in Kenya. It's not about the rainy area. There are trees for the dry area. There was an article, I believe, just last week that talked about different trees for northeastern, for the arid areas, for Makueni, for all these areas, because they're there. So let's do everything that we can to encourage Kenyans to plant trees. It will make a difference. It will change the story of drought and flood. That is the idea of change the story. Our other priority, as I said, was scaling retail banking. We continue to grow significantly. 17 branches opened in Kenya since we started implementing their strategy. We have again backed the trend. Everybody is talking about closing branches. We went against the grain. And over time, you've seen a few banks now join us and say, actually, the strategy makes sense. Actually, customers care a great deal about presence. So we continue to open branches. We are opening 7 branches this year. We're on track to open 7 branches this year. And that strategy will continue until, as I've said before, we are a walking distance from your wallet. We are a walking distance from your wallet. That is the strategy we have embarked on, okay? For you as our customer. As I said, I'm talking to my customers in this room. The good thing is that, and I know people have asked, do these branches are they profitable? Do they make sense? When you open a branch, we typically target to turn it profitable within 2 years. Within 2 years. That's sort of the horizon we work with. And right now, since we started opening branches, about 3 of them have actually started breaking even. So they've already turned profitable. And we're on track to achieve our target on 2 years. 1 became profitable less than a year. 2 of them within a year and a few months. And I believe by the time we hit 2 years, each one of the branches that we opened, each of them will meet that milestone. Corporate banking, another area that I talked about, deepening leadership in corporate banking. We say deepening leadership because NCBA is the number 2 corporate bank in this market. Whether you look at it in size, the number of customers, the deposits, assets, we're the number 2 corporate bank in this market. Once again, the kind of customers we support in corporate banking tend to be historically locally founded companies. That's why we're very proud that we support locally founded companies to build their businesses. Last week, we were in Samburu, where the president was launching the Defki Steel plant, and NCBA has been a big supporter of a company like DevKey, which is a homegrown corporate, and many other stories that we can tell about companies that we support. Leadership in asset finance, I think we have all been known across the country to be very strong in asset finance. I think what people don't know is we do own a platform called Kaduka. We've never publicly announced that we own Kaduka, but you may have seen Kaduka. On Kaduka, you carry out live auctions of vehicles. You can buy insurance. You can apply for a loan, which is processed within 15 seconds. You can buy spare parts for your vehicles. And indeed, you can even book a ride and a car service on the Kaduka platform. That's owned by NCBA. Something that we developed a while ago and something that we have started now to promote, because we believe that we must build the whole ecosystem of asset finance, that just buying a car is not enough. We must follow your life as you own that vehicle, as you experience that vehicle. How do we create experiences of asset finance? That's what Kaduka is. I urge you to please just log on Kaduka, even if you're not buying a vehicle, just to browse the vehicles that are available on Kaduka, both our vehicles that we auction and many other banks and other corporates that are auctioning vehicles. They are listed on Kaduka site. I urge you to look at it. Lastly, let me talk a little bit about digital transformation. Digital transformation for us, we view it in two rays. One, the first ray is what we call the core bank, the traditional bank, the work we do for our traditional banking customers. We have been leaders in we're the first bank to bring internet banking in this country. We're the first bank to bring mobile banking in this country, and we were. And we've continued to develop mobile banking. So today, one of the apps that I like to talk about is our app for our traditional banking customers. And what you see there at the bottom is the ratings of apps, of our peer bank apps in Kenya. And what you see is NCBA's app is rated the highest, 4.8 on the Google Android store, compared to the next strongest competitor at 4.4. And you can look it up. Just look at Kenyan banks apps and see how they're rated. Because we deliver experiences, again, through our app. Through our app, you can do almost everything. This week, we have added unit trust, so you can actually do savings through unit trust, and that is available now on our app. You can apply for a loan. People talk about the fact that we give them Mshwari, this KCB M-Pesa, all these loans. NCBA customers have another loan we call NCBA SASA loan, which is a click of a button, and immediately you get a loan. And I encourage you again to try it. It's called mobile loan on the app. Go for it, because we're NCBA. The other way that we look at a digital business is the fact that one of the biggest social impact things that we have done as a bank is create financial inclusion products such as Mshwari and Fuliza. And these obviously have been a topic of discussion recently. I think we were with hustlers before people discovered they're hustlers, if I may. We deliver these products to them, and we continue to develop and evolve these products. More recently, you saw we announced about pricing changes to Fuliza, because we are always careful to ensure that we are listening to the needs and aspirations of this group of people. In terms of our business, how it's doing, as you see here, it has continued to grow from strength to strength. These are disbursements of digital loans. Disbursement of digital loans from year to year. Quarter 3 of 2020, you'll see 310 billion shillings. Quarter 3 of 2022, this year, as of quarter 3, September, end of September, we disbursed 521 billion shillings through our digital loan program. These are mama bogas that wake up 5 a.m. in the morning or 4 a.m. in the morning, get an Mshwari loan, buy a bag of potatoes, sell it, and repay before the end of the day. There's a parent who is taking a kid to school. Kid needs to eat. They don't have money to eat. They get on Fuliza. They buy them a loaf of bread to take to school. These are the stories of people. These 521 billion has gone to millions of Kenyans. Some use it daily. Some use it once a year. Others, like me, use it once every 2 years, but we use them because the moment comes when you need to use these products, and that's why they are there. But to tell you more about our digital business, I shall ask Eric Muriuki, our Group Director for Digital Business, to come on stage and talk a little bit. And after he's done, he shall then invite David Aboga, our Group Director for Finance, to tell us about the finances. Thank you.
Good morning again. As introduced by John, my name is Eric Muriuki. I'm the Group Director for the Digital Business at NCBA Bank. It's actually a very proud moment. This month marks the 10th year anniversary for this business. We launched M-Shwari 10 years ago on 12th of November. And quite happy to be able to continue with the narrative that John has introduced, that we have been is it right to say the hustler bank or the financier to the hustlers for the last 10 years? The data, as we're showing here, shows very strong performance. I think maybe just to give a little bit of context, that 521 billion of disbursements is specifically relating to Fuliza and M-Shwari. About 460 billion of that being a turnover from Fuliza, and about 60 billion of that being M-Shwari. Of course, with the recent announcements that we made with the reduction in price on Fuliza, we've seen this business actually continue to grow, about 14% increase in turnover since this change in our pricing model. We also had a very important change, which somehow is not getting the attention, but that was the most important change we applied to Fuliza, which was to increase the number of days that customers have a waiver when they draw down on a Fuliza loan from 1 day to 3 days. And that has had a very positive impact, where we've seen the number of days to repayment reduce from an average of 14 to 19 days, and it's coming down now to 10 days. And these were changes that we had actually intended to institute, and we're able to see the right outcomes coming out of that. The other thing I want to give a bit of information and some context about is we also, at the time when we were announcing the changes to Fuliza pricing model, there was also an announcement with regards to our intention to introduce a credit repair mechanism. This was reviewed and supported by the central bank, which they did issue a press or a circular to all banks, providing a framework where millions of customers who are today negatively listed with the credit reference bureaus and are either suffering some form of intended or unintended sanction with regards or resulting from their credit records at the CRB, were to be offered a relief of about 180 days starting from 1st of December. So we've already instituted this change. We've already completed the reclassification of more than 5 million M-Shwari and Fuliza customers. The communications actually to each individual began going out from yesterday. All of these customers have had their records with the 3 credit reference bureaus updated to reflect a positive status with the CRBs, which then means that any sanctions owing to your credit reference bureau status is now, you now have that relief for the next 6 months. The framework for credit, the credit repair window was actually given by the central bank up until the 31st of May in 2023. The second step towards that is then to engage our customers directly, and every digital lender is preparing to engage their customers directly to then present them an offer in terms of how we shall execute the 50% discount that was announced by the regulator. Our plans are well advanced and effective 1st of December. All M-Shwari customers and all Fuliza customers will be getting a discount of at least 50% if they repay their outstanding facility within the window that is provided by the regulator. We will also be considering enhancing that discount for customers who would be able to pay back sooner. And the whole objective for this is to use this momentous occasion to try and as we had said, to try and give these customers who, for one reason or the other, and when we looked at the data, a lot of customers actually fell back on their repayments during the COVID window, or as the economy began to tighten, particularly at the beginning of this year. And a 50%, which could even get better, discount on their past due loan, and more importantly, present these customers with a journey to reinstate them back to gaining access to digital credit, at least through Mshwari and Fuliza. The last thing I'll talk about, which is very exciting for us, is we as an NCBA group have taken a decision to then say at this 10-year milestone, what have we learned? What are the capabilities we have built? And the shareholders have taken a decision to pivot the NCBA digital banking business out of the bank and onto a standalone fintech organization, with very specific objective of realizing the opportunity that we are seeing all across the market, the African market, that is. As John had stated, NCBA is the only financial services institution in East Africa that is doing business in West Africa, and specifically Francophone West Africa. But when you look at that region from the Indian Ocean to the Atlantic in sub-Saharan Africa, there's 500 million customer opportunity. The capabilities we have developed within the digital business give us a very strong and a very clear path to realizing profit, not just from Kenya, but actually growing profitable businesses beyond Kenya. As a country, we're very well known for our very traditional exports, tea, coffee, horticulture, flowers. And when you look at the endowments Kenya as a country, and more so NCBA as an institution has, we are looking to start seeing digital financial services actually as an export product beyond Kenya and into the region. This will have, of course, the benefit of creating high-value jobs here in Kenya, servicing the whole of Africa, and also creating a channel for some of the partners we work with. If you're a partner of NCBA and we're now doing business in Cameroon and Nigeria, then there's also an opportunity for our partners to tag along with us as we go beyond our traditional East African market. So this pivoting of the business also has caused us or required us to think about our technology. We've just completed the replatforming of our business, and that will see us launch a brand new digital platform service sometime in the very near term in Kenya. And by 2023, we'll be looking to expand or roll out this platform into 8 other African markets by 2023. The objective here, of course, is to ensure that we can diversify our revenues from beyond Kenya, to be able to see that we are generating significant more of our revenues for the digital business. We're actually anticipating to generate this from outside Kenya, or actually outside beyond East Africa. And this is a wonderful opportunity for NCBA existing shareholders and potentially new shareholders to realize value in this kind of an organization. Thank you very much. I will happily invite our Group CFO, David Aboga.
Seems I'm the only one who's come on stage with some water. Good morning, everybody. And thank you, John and Eric, for providing a background on some aspects of the group performance and the operating environment that we have been dealing with. It's indeed a pleasure to, be discussing our Q3 2022 performance with yourselves. And what I intend to do is, following on John's presentation, is maybe start with, what's our group-wide financial results, and then talk a little bit about our subsidiaries, discuss our operating efficiency, some of our lending and deposit growth, and then lastly, just close with a little bit about what we see going into next year. I think, and John did put up a slide, we're about halfway into our strategic cycle, 2020 to 2025. Actually, June or thereabout is a midpoint. And from the discussions, I think 2021, 2022 have been very, very important years in that strategy. More so because I think we have continued to really deepen our relationships with our customers. And that ideally has been, the backdrop of the success of our strategy. The results we'll discuss shortly, demonstrate that there's been what I would call market share gains. We've onboarded new customers. We've continued establishing better relationships with the existing customers. We had a COVID phase, obviously, that called for us to really support them a lot more. And as my colleagues have discussed, some of the support mechanisms as well on the digital lending side, I think were very, very pivotal in that. So we are very encouraged to still see that customer engagement continuing to grow. I'll start with a view about, the group's performance on an overall basis. We've had an excellent performance, I would say, overall in most of our businesses, underpinned by a very, very strong non-funded income contribution this year. At the third quarter, we are reporting the results we've just released. It's a profit before tax of 18.2 billion. This is a 64% growth over where we were last year at the same period, the 9 months period. And if you look there at the bottom, that's a profit after tax that has doubled from last year to 12.8 billion. In the 9 months, our revenues have indeed increased to close to over 26% over last year. If you look at our net interest income, for example, we are up 15% at 23 billion. Our non-interest or non-funded income is up 40%, reporting 22.5 billion. And, just largely reflecting what I said, some of the continued market share gains and the customer relationships that we continue to build on. In summary, our operating expenses here look like we had 19% up over last year across the group. Now, we did say that this, at the beginning of our strategic cycle, was an investment phase for us, the first half of our strategic cycle. We've continued investing in our branch rollout to get closer to our customers. We've continued investing in some of our digital business. We've continued investing in technology. Now, some of those investments obviously take some time before they start contributing to the top line. So you may see a little drag on expenses, but eventually the top line growth of income will far exceed that growth in the expense base. On impairments, I think at 8.3 billion, you do realize that's a reduction of almost 10% of where we were last year. This talks to two things. Obviously, we've continued to grow our lending business. The volume itself has grown. Digital, as you saw that slide up there, 521 billion of digital lending. That's incremental volume that contributes to slightly more impairments as well. On the rest of the group and the core business, you'll also realize that our lending volumes have also grown. So principally, increase in impairment is driven by firstly growth in our lending volumes. And then secondly, as we've always said previously, we continue to have a very conservative view of, we need to build reserves. We need to always ensure that we have covered risk that we see existing in our portfolio. So 8.3 billion may look like, it's slightly high. It's better than last year, but it reflects, some of our business growth and our stance towards provisioning. There's something I'd less like to say here. We've got close to about 30 billion of impairment reserves, 30 billion on our total lending. That's, if you computed that, you have about impairment reserves to loans of about 10%. That's indeed a very significant cover of our total lending. That 10% of it is held as provision reserves. On the right is basically some key balance sheet highlights. I think on the customer side, yes, a 3% growth over where we were last year at 462 billion. I think there's a slide downstream where we'll talk a little bit about our customer deposits and what's driving that. We continue to lend. I look at lending as twofold. So that it's almost 520 billion of lending, 224 to government and 300 billion to the rest of our customer base. which has grown. That's almost a 6% growth over where we were last year. And I think my colleague Eric has talked about the digital loan disbursement of about 521. A number of you have asked previously, so out of the 521, how much is sitting on your balance sheet at any end of period? Out of that, I think we had about 19 billion sitting on our balance sheet as at end of September. That's just 6%. And that's because, I mean, the type of product, Fuliza Mshwari, is a churn product, right? You borrow and repay within, what, a week or thereabout? So it's a churn product as opposed to you expecting to see that 521 billion of disbursements in the 9 months is going to sit on the balance sheet because you borrow and repay. So only 6%, about 19 billion of that. If we look at what is the momentum in our business, and we put up this just to look at quarter on quarter, what has the growth been like? I think you'll notice that it's been consistent. If you compare quarter one over last year, right up to where we are today, with a 63% growth of PBT over last year, you'll see that consistently every quarter, we have continued to deliver growth. And even if you just look at the 2022 numbers, from a 5 billion PBT in quarter one, up about 7 billion to 12 billion in quarter two, and now we're reporting close to a 19 billion profit. So there's been incremental growth every quarter in our business. Let's, peel back the onion a bit and look at deeper. So where is this coming from and which entities are contributing to this performance? Kenya subsidiary and the Kenya banking subsidiary today still continues to be, I would say, the principal contributor to our business. 90% across a number of metrics. If you look at total assets, customer loans, deposits, you'll find that the Kenyan bank is 90% of our business. Now, that's not necessarily reflected in the contribution to profitability. The Kenyan bank is still at 18.7, and we're saying a group profit before tax of 18.9, then it's still principally 100% contribution to our business. Our goal, as we said earlier, was really to try and get our subsidiaries to improve and contribute. That's similar share, 10% of our group profit should be coming from our subsidiaries, just given the asset size and loan size and deposit size that they contribute. The regional banking subsidiaries, collectively, I think you can see we almost break even at quarter 300 million loss. Same period last year at about 1.3 billion. But if I start with, the positives, Uganda and Rwanda. Uganda, I think we discussed this even at the half one results release. The economy opened up around about January, longest lockdown period they had. What we suffered last year was largely impairment provisions on our digital lending side, largely. Because of that long shutdown, businesses were shut. The digital borrowers in that market were unable to fund their loans. And then we took the impairments last year. We've seen a lot of recovery this year from some of the impairment risks we booked last year. And so with that reopening of the economy there, you can see just at under $500 million contribution of that Ugandan franchise. They start contributing positively to our group. Rwanda, I mean, significant growth. We had 43 billion last year, same time, 300 million contribution, 332. We've seen very healthy growth on the balance sheet, number of customers that we've onboarded, the client relationships that we've continued to do more with our existing clients. We've opened a couple of branches in terms of expanding our network in Rwanda, and all these have contributed positively to the performance that you see there, 332 million. I talk about Tanzania last, and I think this is a continuing conversation we've had. Obviously, a loss same period last year of about 400 million, and now we're talking about a 900 million loss. I think what we said in the past at half one is that this was the year that we were looking deeply into our Tanzania business from a number of perspectives. One is really redefining what is our business model going to be in Tanzania. And that led to a couple of things. We sort of closed down a couple of branches. We reduced our staff complement in Tanzania. All those things do come at a cost. But most significantly, we also looked at the credit risk that was existing in that business, and we said, no, we almost need a fresh start. And we've been very conservative in saying, let's take the impairments upfront, even as we go after resolution and recovery with our clients. So that's what you see in that Tanzania business loss. I think we are at the tail end of this, and our projections are that, right now, if you look at our business, it's already operationally profitable. And I think going into next year, I think all these regional subsidiaries should be contributing positively, and at least attaining, I think John's target is they must contribute equal to their size, right? So we do expect at least a 10% contribution from our regional subsidiaries next year. If I turn to the non-bank subsidiaries in Kenya, that's, of course, you're aware about our investment banking business, our bank assurance, and our leasing business. And this enables us to be, to have a universal offering to all our customers and provide sort of a one-stop shop for them. About $500 million contribution last year, this year, for a variety of reasons. Some businesses are up, others are, the investment bank has continued to contribute positively and is up over last year. Our bank assurance business, slight reduction over last year. But collectively, all these three businesses contribute about $500 million if you sum all that up to our profitability. So again, are we happy with where we are with this contribution? Yes. Do we believe that it offers our customer a sort of universality in terms of they don't need to look elsewhere for these services? And that's a principal reason why these offerings are there. The only other item I'll talk about on this page, I think, is then exceptional items. What does that constitute? I think it's two factors. So one, there's an element there of what I'd call a staff voluntary exit program that we did for our Tanzania business. There's about 200 million sitting on that line. And the rest of what is there is, we did explain that at merger, we had to book some intangibles which related to, you look at your customer deposits, customer relationships, you value them, and then you start amortizing them over a period of time. And we said that now we are basically done with that amortization, so you do not expect to see any major amortization coming from that exceptional item going into next year. Very briefly, what is underlying performance here? We see that operationally, I think our income in the last 3 years, if you look at our CAGR over 3 years, has been growing faster than where our expense base is. That's an 18% CAGR growth on income, while expenses have grown at about 10%. And we think that some of the investments we've made will continue to generate much, much better growth on the income side. If you look at the graphs on the right, for those of you who can see the screen, a much better cost to income ratio, I think, which shows the kind of levers and control we have on either expenses or growing our top line income. But more importantly, a measure that we also look at, which is what is staff cost as a percentage of our operating income. That ratio has been coming down, which means that we are generating income at a faster rate for the number of people that we have. Deposits, slide, I guess this is slide what, 31, yeah. So the focus has really been on how do we reduce our cost of funding? How do we reduce cost of funding? I think a couple of you have challenged us in the past that we look like we carry very high expensive deposits. If you look at where we were last year, our CASA, which is your current and savings account, which of course come at a very much lower rate than your term deposits, is up 9% or about 20 billion. And that has a significant impact in how it contributes to our cost of funding. I think John took you through the branches we've opened. That's part of the reason that the branches are now contributing positively by generating better CASA for us and reducing eventually our cost of funding, which means that we get better NIMs and we can then report much better profitability. But I just wanted to comment that I guess driving this, if you ask what's driving this, you've got business actions firstly. We have to manage deposit pricing, there's no doubt. And we have to continue, our customer relationships and how we deepen those relationships. But there've been also significant new customer wins. So it's not just about existing, there's also new business and new to bank business, which is the significant customer wins that have driven this. On the lending side, the conversations we've had here again previously have been, you seem like you're flat on your lending book. I think now you can see that where we are, there's been growth in lending. Corporate side, we have indeed helped our customers to not only contend with volatile markets, but also in terms of how they could reconfigure their supply chains and what are their funding needs in the short and long term. And you can see that growth on the corporate lending side. On the retail side, a 19% growth in retail lending. And that means, just how is our strategy focusing on whether it is the personal, the SME, and the business type lending. And you can see that now starting to sort of tick up. As I go towards closing, I think it's important that we talk about cost of risk. And yes, our cost of risk may look high. 8.3 billion of impairment is about 4% cost of risk. It has come down from last year, but this is a function. You must look at this in twofold. There's the core banking business, but there's also the digital business. And as I said, volume is part of the contributor of this cost of risk, just the volume of lending. Our NPL has come down 10 billion from 46 where we were last year. The ratio is now 12.3. I think John said, put up the market is about 13.7 or thereabout. I think at half one, we were a lot higher than this. And the target we set is that we were working on resolution of our NPLs. And you can see that coming through in some of the results that we are putting up. And I mean, before I move on, so coverage is an important thing. And I talked about almost 30 billion of impairment provisions across the book. If you look at just for the NPL, it means 65% of our gross NPLs are covered from a provisioning perspective. If you layer on the collateral we are holding, then you've got more than 100% cover on our NPL. So we do not see incremental risk from our non-performing loan portfolio. But that doesn't mean we don't continue, resolution and following through with our customers on that. I think from a shareholder return perspective, just to rehash, at half one, we declared an interim dividend. We paid 2 shillings, which was about 3.3 billion in quantum on 30th September. I think you see there that the return on average equity, if it's annualized, you should be in the plus 20 range, 21.8%, significant improvement over last year's results. And at 9 months performance is a 7 shillings and 70 cents contribution to earnings per share. I think that's a great improvement from the 4 shillings earnings per share position that we were at last year. I think before I invite, John to then wrap up, I think I'll just say we continue to execute, obviously, on our strategy that we've laid out. And I think we continue to see a lot of business momentum in majority of our businesses. The financial path will never be linear. But I think we are very confident that we shall meet our midterm targets and even some of our longer term targets that we have set up. So strong results thus far. Not to forget that there are risks and uncertainties in an environment like ours that we look out for. But I think we have every confidence in where we are at this point in time. So let me invite John back, maybe just to wrap up with some of the financial guidance metrics that we set out at the beginning of this year. Thank you.
Okay, thank you. Thank you, David. Thanks, Eric, for your presentation. I hope you've been able to see that we're on a clear strategy. We're executing it. Our results demonstrate, I guess, is a measure that we use on our execution. Before I talk about the guidances we gave, I urge you, as you analyze our results, to also look at other banks' results closely. This is important because what you see is that everything for us is above the line. All the numbers we are showing you, they are above the line. Okay? So I think this is important. When you analyze results, quite often I see comments and you don't analyze all the lines that we show. Okay? I think the conversations today are about how you report your provisions, being one of them, how you report your mark to market, being one of them, and a few other things, what we call, your fair valuing of your investments, one of them. I mean, many other things that banks use to tell their story and their performance. So as you analyze every bank result, it's important to look at those lines. I think the other conversation that you will all comment on is on the FX line. Again, very strong performance on FX. Again, look at the other banks as well. It's not an NCBA windfall, I suppose. It's an industry windfall. Why? Because it's been a tough FX period. NCBA, what it has done is to go out of its way to ensure taking some risks that we've been able to deliver more FX into the market than any other bank. We're the biggest provider of FX in this market, and we shall continue to do so. And that's a decision we made because we must support this economy. We need FX for fuel. We need FX for edible oils. We need FX for manufacturing. We make sure that we're an integral part of supporting this economy that must continue to turn. So finally, just looking at the things that we promised we shall do. These results that you see here are for NCBA Bank Kenya, but as David said, we're about 99%. NCBA Bank Kenya is today about 99% of our results. So I think it's fair to say this will be our group guidance as well. So we give guidance on return on average equity for shareholders, a big concern that was in 2020 and 2021 for us. As you can see, we promised we'll be above 15%. As of now, we are 21.5%, a very strong performance in terms of return on average equity to our shareholders. NPL ratio was also a concern, and I think a number of you asked us about that at the end of last year, at the end of quarter one. As you can see, we promised that our NPL ratio would be below 15%. The market average today is 13.7%. NCBA is at 12.2%. Again, a very strong performance and trending towards the promises that we made. Cost to income ratio, efficiency of how we run our business, 36.9%. Now, at 36.9%, I want to remind you, we have opened 17 branches since you started to be on this strategy. In other words, the amount of investment cost we have incurred is significant. So again, when you look at the growth of expenses, that's where it's come from. But look at our efficiency. We're doing that while being very careful that the revenue is also responding to those investments that we're making, hence maintaining a very strong efficiency ratio. I guess the only other one I'll mention is the core bank cost of risk. And David has gone through that presentation. This has been a concern for NCBA because if you recall, in 2020, we had the highest provision number relative to balance sheet at close to 22 billion in provisions. We brought that number down significantly. As you can see, we promised we'll be between 1.5 to 2%. It's about 2% as of now when we measure it. Now, obviously, as David said, there's some risks to some of these numbers. Quarter three, we are looking at what happens next year. And a lot of the conversations you hear, a lot of the pronouncements you hear from government about, paying suppliers, I think has come up before, and many other things are things we are now examining this quarter to see where we end up on that number in terms of cost of risk. But it's just to tell you, on what we call normal running scenario, we are below 2% in terms of cost of risk. So, ladies and gentlemen, I present our results. Hopefully, they meet your expectations. I started by saying you're a customer. I end by saying, if I were you, I'd also become a shareholder. Thank you very much.
Thank you, John. Thank you, John. Thank you, David. Thank you, Eric, for the detailed information on our results. Now, if you notice, we've taken an hour to really detail the performance of the bank, which is a strong bank, a leader in many aspects. But what's important is to empower you with information on this brand. I think where we are with the economy in Kenya is a situation where we need to empower the news, the media, our customers, our consumers on exactly what is expected in the next 18 months when it comes to the economy, but also empowering you with the information on the bank and its performance and where growth pockets are coming from. Now, being the communications director at NCBA, every time you plan for technology, it always fails you. You can ask the team. We ask what could go wrong. And we go through all of the questions, but you never tell which one will go wrong. So today was interesting that a black background can actually determine what happens to your PowerPoint. So that means a lot of opportunity when it comes to digital. I think in Kenya we call that character development. Somebody was laughing about it, but never mind. We are always on a journey when it comes to digital. We thought we would have a question and answer session for those who have extra questions on top of the detailed information you've received today. So I will invite back our CFO, David Aboga, Louisa, our Chief of Staff, and Eric, our Digital Business Group Director, to come to the podium, and we will take questions. So Frazier and Patrick, if you could help us with any questions from the media team, that would be great. And we have a mic already up. Sharon is on that side. So do we have anybody with a question? Kefa, I see a question from Citizen. And please introduce yourself and the media house you represent. Thank you.
Yeah. Good morning, Kefa Moirore, Citizen Digital. Two questions, one to Eric, one to John. I begin with Eric's. More details on the credit repair mechanism. I think you mentioned around 5 million customers being at least engaged. Might you have a quantum of how much you might be, don't know if I use forgiveness or forgoing. The guidance was around 15B for all banks, so I'd like to know how much of that goes to NCBA. And perhaps if the clarification, if I got the 5 million correct, just you are quite fast going through that part. Then to John, you're the biggest digital bank. In 9 months, you're already doing 521B. So you don't really need much help doing the digital loans. You're already successful in it. But there's a fund coming up from government, referring to the Financial Inclusion Fund, Hustler Fund, depending on how you call it. What opportunities do you see there for NCBA, this talk of matching up funds from also financial institutions? Have you considered, and perhaps what might you share at this point? Thank you.
Yes, we can go ahead and answer Citizen's question, and then we can proceed to the next person.
Thank you, Kefa. I think my response is very simple. Of the 15 billion, M-Shwari and Fuliza combined, we are accounting for about 11 billion of that. And the context is important. We are looking as far back as 10 years. Most digital lenders have only existed probably the last 3 or so years. We were the first in the market, actually the first to do digital lending, mobile-centric digital lending, first in the world. So when you look at our stock of loans, because of our history, that will tend to be the largest. A significant part of that is actually Fuliza, and we are the only lender that is underwriting Fuliza loans, at least as at the point when this decision has been made. So that's the context. The 5 million number is the number that M-Shwari and Fuliza, specifically underwritten by NCBA, relates to.
So technology again. It is what it is, right? So on the Hustler Fund, I think let me first just comment on what Eric has said. 5 million customers. It's a very big number. Yeah, 5 million customers. That's 10% of Kenyans already use, or at least have used, digital products developed by NCBA and its partners. With many more millions who are not listed, yeah, or negatively listed. So what does that mean? What does that mean? It means that we have taken time over 10 years to build a culture of borrowing on digital at the convenience of your mobile phone. We build that culture in this country. And I believe it's because of that culture that we built over that period that the government is so comfortable that they can deliver the financial inclusion fund through mobile, isn't it? So we're actually very proud that we tested the thesis. It worked extremely well. The government, our own government, has taken that thesis that we built, that credibility, that business that we built, and they're going to deliver perhaps the biggest social impact fund the country has ever delivered. So when you ask about opportunity, we're first very proud that something we started is being used in Kenya for social change, which is exactly what I talked about before. I said it's financial inclusion, it's social change. That's what government has seen that opportunity to use that platform, that mobile platform, to deliver this social inclusion or financial inclusion fund. So in terms of opportunity that we see is that we spend quite a bit of money marketing, I'm sure, quite a bit of money marketing Fuliza. We probably don't need to anymore. Yeah, because it's becoming mainstay. It's becoming the way of doing business, isn't it? So we see as an opportunity for our own business that's going to grow. People who are not used Fuliza, people who are not used Mshwari, the moment they use Hustler Fund, will get hooked to the fact that it's convenient, it's easy, they can use this product easily. So for us, it's just a growth in our market. Yeah. Finally, is that we have given ideas in terms of inputs to how that Hustler Fund should be structured, how it should be delivered, what are the enhancements can be made to that Hustler Fund, and that's a contribution to Kenya in our view. So I think in every way possible, we see opportunities, whether we participate directly or indirectly in this financial inclusion fund.
Thank you, John. Fraser, my recommendation would be for the media houses, let's have one question so that we give at least 5 of them to ask questions. And we can direct the question to John, and then he'll be able to aptly direct that and moderate with the rest of the executive team that's here. Thank you.
My name is Brian Jodotieno from NTV. In the spirit of looking keenly into other banks' results, as recommended by Group MD, we are seeing a lot of banks going into wealth management, investment banking, and the like. And for example, ABSA just got into the business, issuing unit trust at about 7%. So I guess, David, again, this one you glided through real quick. We just want to know more about the unit trust branch of the banking business. What's the ROI? How long has it been in place? And what is the uptake rate of such options? Because we are seeing people needing more of these services, and with the growing information on financial literacy, people, I guess you've had this conversation out there, don't save your money in the bank, save it in a money market fund and all that kind of stuff. So we are seeing banks also going into this area. So would you like to speak more about that? Just want to get more info.
Okay. So that's NTV.
My name is Elizabeth from Business Daily. I think I had 2 questions, so I don't know if I could just be allowed to go on with the
Go
2.
ahead, Liz.
So one is on the NPLs. I think it's fair now that I may ask the question. We've seen for the bank has dropped from 16.2 in Q1, very fast, I think, if I can say, to 13.2%. like I said, I think it's fair I can ask that. What is really pushing this decline? Again, what is the measures that the bank is taking? And about two is maybe on the economic outlook. Maybe we've seen the CBR has increased to, sorry, the central bank rate has been increased to 8.75. I know we've been seeing also the private sector credit growth increasing, but there's also the stories on the expectations of the global recession. How do you see this maybe affecting maybe the economy, and especially in the part of the bank performance?
One more. Okay, we're good. Thank you. John, we can.
Sorry again. So on Brian's question about wealth management, indeed we are actually one of the largest wealth management banks in the country. Yeah, we run our wealth management through our investment bank. We have an asset and wealth management business. We are managing about 42 billion in assets today. And there are a number of products, not just the unit trusts. We have dollar funds, we have shilling fixed funds, what we call basket notes, which is a mixture of a number of things. And we do what we call private wealth management in there. So about 42 billion of assets under management. We should be somewhere one of the largest of the banks. So yes, a number of banks have announced it. I've seen, I think ABSA, I've seen INM and a few others announce it. I think Stanchart is very strong in this. I would say they're probably number one, and we follow fairly closely. Okay, so I hope I've answered that question. So it's not new business. We are starting something we do. Also, through digital, our Loop product also has a savings and investment catcher or opportunity. Yeah, our Loop Invest, I think Eric's about 7.3% return now, at about 7.3% return, and there you invest little by little. And maybe I should also talk about the savings conversation that has been a big focus for our president, to say that one of our biggest pride is that M-Shwari, whereas most people talk about lending, and we talked about lending today, it was actually founded as a savings product. It was founded as a savings product. And it's a save kidogo, save a shilling, save 2 shillings, save 50 shillings. And doing that, Eric, we have about, I believe, about 32 now, 37 billion actually, 37 billion in savings from these customers, saving as little as 100 shillings and as much as a few million through Loop at the comfort of your house. And even those who are saving millions, it's not that they deposited. They deposited 300, they deposited 500, they deposited 20,000, because obviously the M-Pesa, it's a limit as to how much you can move. And over time, they have accumulated millions. So I encourage Kenyans, there are many options to save. M-Shwari is a fantastic way to save, and you get very good returns, even on M-Shwari. Elizabeth, you asked a number of questions. One was NPL. Yes, you had called me about it, and I said I couldn't comment. Yes, now I can comment. And indeed, I'll actually ask my CFO to comment on why our NPL ratio has come down significantly.
Thanks, John. So when you look at NPL ratio, you look at, both the numerator and the denominator, right? So when we started this conversation, you have a stock of NPLs that you want to deal with, and there are various ways of doing that. Firstly, it's just, we did mention here, I think in the last 2 quarters, that we were having a lot of bilateral conversations with our customers on how to help them resolve the NPL situation. That means 2 things. Either you agree on a settlement plan, or secondly, you agree on collateral realization, because you're probably holding some collateral, and so you go ahead and realize collateral. So that basically deals with that stock. Okay. From a ratio perspective, you're also growing your lending, right? So even if you have the same stock, you'll have a lower ratio if your lending is growing. So the lending book is growing as well. But the significant one would be, if you think about the flow, and that is new NPLs. I think I would say that what we've seen in terms of new NPLs is that there's been a slower flow into the stock of NPLs. So we're not getting new NPLs coming onto the book, which talks to then the credit process before, you know, a loan becomes delinquent. But obviously, I mean, we are still operating in a tough macro environment. Resolution for us of this NPL still continues to be key. That bilateral conversation with our customers to reach settlement plans or collateral realization or work through the courts for resolution. Because some of these are also at the court process. And so you find that you're stuck because, you know, there's a court process and you've got to see the court process through. But overall, I mean, that 10 billion reduction, and this is not just Kenya, this is across the region. I think we're doing exactly the same across all our countries where we have presence of banking. I hope, Elizabeth, that gives you a bit of color of why that. And you'll see then that, obviously, as you write off some of this, the coverage may have reduced. I think we set a target. We said that we want and intend that we should cover from a provisioning perspective, I think 60 to 70%, upper end being 70, but not less than 60%. We're at 65% of provision coverage for our NPLs before you even talk of collateral or any security you're holding or future cash flows that you expect from these clients. I think if you layer those on, then you'll find that what we see is very minimal or none incremental risk in the existing book. You actually expect you'll probably come out with a better recovery. Thank you.
I think you asked a question about forward-looking. Yes, CBR, as I mentioned, has been rising, latest 50 basis points to 8.75. What that means is obviously that is reacting to, as I said, the very high inflation environment that we continue to see ourselves in. If you look at the actions taken by central banks globally, the actions taken, we're starting to see positive response. I believe in the US, the inflation has turned the corner and is starting to come down. Our projection is that will continue to drop until somewhere around June of next year. When we think in the second half of next year, central banks will feel comfortable to start now to stop the tightening posture that they have taken. I think even for us, that's sort of what I think will happen. We have to go through the rainy season, the long range, and depending on how the long range look, that's what will determine how our food inflation especially looks like. So I think we're also looking at mid of next year to be certain about the direction of CBR. That said, I think the government is very intent on keeping rates down. I think you've heard the president saying that himself. So it also depends on what other fiscal measures they come up with that could force either inflation to come down or to support low interest rate environment in a situation where inflation is also contained. It's usually a difficult balance, but we hope they have great economists who come up with something. What does that mean for banking? I think our outlook is still actually quite positive. We do think that the government has also talked about investments that they want to make. They have talked about employing other methods of raising money to pay suppliers, to clear debts. And if they execute on those plans, I think there will be money for investment. And when that happens, we expect to continue to see growth. Also, we're coming from an election year, which was coming right after COVID. So in terms of private investments, the last 2 years, 3 years, in fact, have been muted. So we expect now with the stability, the great transition for the elections, that private investments will start to expand. And if that happens, it will support bank performance. I think the line that is most at risk for next year is the foreign exchange earnings line, which banks have had a really good performance in this year. That depending on what happens to the dollar, is already starting to weaken after going a very period of strengthening. Depending on what happens to the dollar, we may see the FX lines start to moderate. And that is a line that we watch for next year.
Thank you, John. We've come to the end of our formal program for today. Based on the timing that we have, Maina, I think we can cover the rest of the content in our special interview with our Group Managing Director. Thank you very much on behalf of the NCBA family to our panelists, our executive committee, from Mr. Gashora, our group managing director, our group finance director, David Aboga. Thank you very much, Eric, our group director for digital business, and our director for strategy and chief of staff, Louisa, for being present today and sharing the information on Q3 results for NCBA. Asanteni sana, we appreciate the Fourth Estate for continued partnership and leveraging the good work that we are doing as a bank. We look forward to continued partnership in the ongoing engagements. Asanteni sana. Patrick, I believe we will end here with our panelists. There would be a photo opportunity on the outside, just where we have branding, and then we can take our group managing director in for the special interview. Thank you very much. I've been your hostess, Nelly Wainaina, Group Director for Marketing, Communications, and Citizenship at NCBA. Asanteni sana, and have a warm, hopefully pleasant day today. Asanteni. Thank you. Thank you, guys.
Machozi yangu yote namalizika, mie